This podcast is brought to you by Doc Steels. Find the best deals on gold and silver online at sdbullion.com/deals. This week's Doc Steels features our first allocation of 2017 Silver Eagles, as well as Elemental Silver Buffalo rounds, just 59 cents over spot for any quantity. Find the best deals on gold and silver online at sdbullion.com/deals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Dave Kranzler. Dave, it's great to have you back on the show.
Thanks for having me on again. I love doing this show with you guys. I always learn something too.
Well, it's been quite the week for the markets, really 2 weeks. And we're not just talking gold and silver, but the bond market, currency markets, not to mention India and their currency reset. So we got a lot to talk about. And actually, we have a breaking story here that we'll dive into as well. The U.S. Mint this morning has alerted their APs that they have stopped production on 2016 Silver Eagles, and they're taking no further orders for 2016 for Silver Eagles. They'll be producing no more coins, and no more coins will be available until the 2017s come out at the end of January 2017. This is quite a shock to the market, the wholesale market, and the retail market, as we were discussing before the show started. As recently as 2 or 3 days ago, several of the CEOs and presidents of the authorized purchasers of the U.S. Mint were anticipating that the Mint had 5 to 6 million, possibly more, Silver Eagles stacked up that they weren't going to be able to sell through by the end of 2016. And they were afraid that the Mint was going to force them to take down backdated coins next year with their orders for 2017 coins. But the massive demand we've seen in the last 10 days after the election has changed things, obviously. The Mint has sold out of their stockpile and shut down production, and they're not going to be taking any further orders for Silver Eagles for the rest of the year. And what we've seen in the wholesale market already, Silver Eagle premiums have jumped about 65 cents on the wholesale market. One of the top two APs has gone from offering us coins from around, without giving exact numbers, around 210, 215 over spot, up to they're now offering coins at 275 over spot to retail dealers. So coin premiums have jumped already at the retail market. At SD Bullion, we tried to hold off as much as we could, and we scrambled to source inventory. We purchased about 40,000 Silver Eagle coins this morning here. But looking at our numbers, that's really only about 2 to 3 weeks worth of sales. And we're hearing that across the market. The U.S. Mint APs think they only have about enough inventory to handle about 2 weeks worth of demand if the level of demand they've seen over the past month or so continues. So it was a big shock to the market, and it sets up a big dynamic as we head into the last 6 weeks of the year. So Dave, why don't we start off with you before we dive into that story a little bit more on the markets and the turmoil we've seen in the bond markets, the currency markets, and gold and silver in general in the past 10 days. What's your take?
My take is it sounds like I better order some Silver Eagles from SD Bullion. I might want to do it before this recording's over. On the web. To be honest, I'm not kidding. I'm on the website right now.
I wish we need to have you on the show more often as unsolicited ads.
Absolutely, I can't. But I do know if I almost pulled the trigger yesterday, actually, and it would have been a lot cheaper than it's going to be today.
Yeah, I mean, the same thing for us as a retailer. Anytime this happens, it shocks you, and it's hard because the retail public, they think the dealers are just trying to price gouge them, and they don't understand that we're now buying coins for higher than we're offering them for sale on the site. And I mean, we only have a week's worth of inventory. We got to kind of make sure we have coins for the next 2 months. So unfortunately, I mean, nobody likes paying up. We don't like paying up. Customers don't like paying up. But unfortunately, that's what happens in free markets. But it's a much better situation than socialism and controlled markets because what happens in socialism is that the U.S. Mint says, well, we're not making any more coins, and oh, by the way, you're not allowed to raise your prices. So it takes about 2 seconds to be sold out, and then nobody can have any coins for a while. So to me, I'll take free markets any day, and prices kind of help alleviate shortages. So.
Well, I wouldn't say fully free because the truth is the manipulation in the precious metals market has actually made these silver eagles a lot cheaper than they would have been 2 weeks ago. So
that is true.
So in fact, there is socialism in a sense being practiced in these markets, and it's been beneficial to people who want to buy right now because these are very low prices in the context of really the last 10 years. So, and I really wasn't kidding about buying some silver eagles today. But yeah, the markets are there's a lot of very interesting things going on. I mean, obviously there's been this precious metals takedown, and I'll just note that I would say, and again, this isn't a scientific calculation. It's an estimate based on, I look at what happens over a 24-hour period every day, and I would say at least 70% of the downside action has occurred during COMEX or COMEX computer, Globex trading hours. So in off hours, in terms of when Asia and India and the physical buying, let me put it this way, the markets where they demand physical settlement of what they buy, which is primarily the Eastern Hemisphere, most of the takedown's been going on when the paper market is the only thing that's open, which would be the LBMA and the COMEX. So to me, that just underscores the fact that this was a manipulated takedown of the metals. And then the other thing, obviously, is the incredible spike higher in the dollar and the cliff dive in the long end of the Treasury curve. So, and what that tells me, I think what it reflects more than anything, I mean, it doesn't reflect the fact that, the Fed may or may not raise interest rates 25 beeps in December. I think sounds to me like 99% of everyone out there is convinced they will, and maybe they will, but the bond market has already way more than priced that in. And anyone who thinks that, the Fed's going to be in a position to raise it any more than a gratuitous 25 basis points is out of their mind. Because I think we're going to see QE before they start talking about another interest rate hike. We'll see QE and rates go back down again. But the spike in the dollar, especially given the amount of dumping of treasuries that's going on from large treasury holders, the latest TIC report showed Saudi Arabia, which surprised me, is also starting to dump treasuries. They dumped a lot in the period covered by the report, which I believe was through September. And China has continued dumping treasuries. That means, essentially these countries are basically selling dollars. So what's caused the spike in the dollar index? And I don't have a good answer for that. I have some theories. I think what's happening is that it reflects, I have to believe that there is a lot of derivative accidents going on right now that we're not seeing because of these sudden moves in foreign exchange and in the treasury market. And there's got to be a lot of interest rate swap derivatives and credit default derivatives that are starting to melt down. And I think the spike in the dollar is reflecting that. And it's what's happening right now with the dollar and with gold is very similar to what started happening in June of 2008. We go back and look at the charts, which I just happened to do a couple days ago. The dollar rose almost nonstop between June and October of 2008, and gold went down almost nonstop. And Lehman filed for bankruptcy, formal bankruptcy. I believe it was, I have the date written down, but it's, call it September 16th or September 19th or something. It's when they filed. And TARP was approved by Congress on October 3rd. And then the Fed started buying treasury bonds in what they called QE, which is really just de facto money printing, in November. So that, I'm not saying that it's going to play out like that again, but I think, whatever was going on behind the curtain that caused all those events, something like that is happening right now somewhere in the world.
We're also seeing stuff going on in China, and the renminbi is at the lowest level it's ever been vis-a-vis the U.S. dollar. People in China, the policymakers, are kind of freaked out about that, and they're, as of now, in this latter part of the week, talking about calming the moves and the deceleration that they're trying to engender. And if we think back to August, September of 2015, when China basically sent a heat-seeking missile signal to the Federal Reserve, when the Fed and Janet Yellen and all of their jawboning circus that they did about interest rate normalization going into that December 16th raise last year. I mean, China basically sent two missiles, actually, now that I recall, back in that August-September timeframe, when they let the currency devalue vis-a-vis the dollar, and it sent the S&P 500 down almost 10%, and the gold space was doing in that time frame as well. And to some extent, we're seeing a slight echo with what happened back then now, I believe. And I think that the policymakers in the United States in particular, looking at the 30-year bond going over 3% and no sign of slowing, the dollar going over nearly 102 on the index. And, it's got to engender a lot of fear of exactly what Dave is talking about in terms of the derivative market stress that could happen and things that could just, unravel, but also the direct impact on economic growth and the headwinds that overall rising dollar represents as well when it comes to the U.S. economy and all that. And I still think that whole thesis of the bond market basically serving as a black swan is still valid, and that even though more people in the financial space are aware of the risk factors of a long end of the bond market going cuckoo and rising much, much, much faster than anyone believes, that's still something I think that is largely not appreciated by the average money manager on Wall Street, even though it's now something that people are kind of whispering. There was an interesting story recently on Zero Hedge talking about Bank of America talking about how, some 30-some-odd% of bond traders are now worried about stagflation and the interest rates shooting higher in 2017. So that whole thesis is beginning to get into people's minds, but it's going to be a while before that serves as afterburners for precious metals going higher. But it looks like this week is trying to stabilize, and we had Janet Yellen before Congress yesterday, and immediately following her presentation, gold was taken down, the dollar was shot higher, and bond markets were still strained. And today, we're kind of reverting slightly towards the mean, not across the entire sector. But I'd love to know your take, Dave, as far as what you think about what these crazy policymakers must be thinking with your experience in the credit markets. You got to wonder that they must be scared to death of what's going on with, long-term rates. And it's worldwide. Germany's backing up. Even Japan managed to get into a positive rate curve situation with their long end.
Yeah, that's a great question, Eric. It's really hard to say, what they're thinking, because you don't really know what data they have access to that we don't. And I'm sure there's plenty of it. And so that means there's a whole body of information that they have access to and that they can use. But then again, on the other hand, when you see them making statements about, unemployment being 4.9% and the labor market starting to get tight and the economy is, in recovery mode, you gotta scratch your head. It's like, well, are they making this stuff up for a purpose, or are they just idiotic? And I really don't know the answer to that.
Sometimes depends on the person, I think. because they do
That's
both.
probably true, but I mean, overall, like, Yellen, I mean, she's
Yeah.
chairman of the Federal Reserve. You would think that she has access to great, not perfect data, but great data, way better data than we do. You would think that, she has advisors telling her what to do based on facts. I don't really know. I don't know what information they have, how they process it, and why what comes out of their mouths to the public comes out of their mouths to the public, especially when a lot of what they say is obviously invalid or incorrect. And I don't like to let my mind wander too far into the conspiracy theory world to put a theory together about what they're doing and why. It's too hard for me just to say that they're stupid and they don't know what they're doing.
Well,
and I guess
I don't know.
there's always that possibility, though. But it would seem to me that, given what we know about the real economy and what's really going on, and I mine for data on this stuff all the time because I got to write the short seller journal every week, and I got the money stock journal, so I have to look for data that most people might not get if all they do is go to Zero Hedge or go to FinViz or Bloomberg or whatever. There's data available out there that those sources don't pick up. And when I look at that type of data, it's like, holy crap, the rug is quickly being pulled out from under this economy. How can they possibly think about raising rates? And unless it's, as you mentioned in your write-up that you sent to us earlier, that the market's already there. It's already much higher than even a 25 basis point hike would warrant. Although the Fed funds and the three-year Treasury bill, which is typically what tend to be the 3-month Treasury bill is a pretty good predictor of what they're going to do with Fed funds rates. Those are straddling 0.5%, 50 basis points. So presumably the Treasury market in that regard is expecting 100% chance of a rate hike.
Yeah. The dollar shortage thesis is basically kind of an artifact of, and to oversimplify just for the sake of not doing a 5-minute discussion, but the amount of debt that has been injected into the European monetary system and the banking system, and that's dollar-based as well as dollar-based debt around the world too, is so large that when the dollar rises, it creates a debt servicing strain, and that's part of what's going on with how the Fed gets themselves trapped in a corner where they have an artificial incentive from the marketplace to push the short-term rates up so that they can try to elicit some liquidity within the marketplace to be able to have financial participants able to service their debt. So that's what's going on when it comes to, one of the reasons why the Fed was forced to raise rates back on December 16th of last year. And I think that we probably will see something like that happen this year when they're facing the round table on December 14th. But it's going to be like last year, a kind of one and done artifact, or maybe they might even be able to do something 6 months later, who knows. But the bottom line is the Fed and all the other central bankers no longer control the long end of the interest rate curve. For the longest of time in economics, people always would preach the notion that the Fed and the central bankers cannot control the long end of yield curves. It's what I was taught in school, and then Ben Bernanke and company decided to rework the rules on everything, and they, for a period of time, were able to get bond market traders and the entire financial world believing that we'd have, capital gains for everyone, never mind negative interest rates. All of that thesis is gone, and I think that it's been a slow motion devolution over the last 6 months or so, and people are now waking up to that in spades with the election of Trump. And this whole bond market stress that will come in 2017 is monumental. And I joked before about central bankers not really knowing what the heck they're doing, Dave, in part because if you recall, back when Yellen did her Jackson Hole presentation, she put out a policy paper that talked about a 70% confidence interval where the various board members, the voting members on FOMC, put out their forecast for where the federal funds rate would be in 2017 and 2018, and they had a 350 basis point spread that they nominated as what they believed to be 70% probability of actually transpiring. You know, would you like some darts? I mean, they're grasping for straws, and they're even in their own documents revealing that they really do not know where the future is going to be, and they're just kind of throwing noodles on a wall, hoping that policies will stick and fix things. And in the process, they're going to break everything, which is what central bankers always do.
Let's
go ahead.
All right. Let's take a moment here before we get too much further and talk about what's going on in India. The situation is rapidly getting out of control, and we're not seeing much of anything in the mainstream press, but I personally am concerned that the situation has the potential to be worse than Venezuela. I mean, we're only 10 days in, and all of India is now spending all of their time in queues trying to convert all of their cash, well, $60 at a time, into currency. And they have to, from several of the reports I've read, as well as one of my own contacts in India has pretty much confirmed the same thing. They're spending well over half their day in queues trying to convert $60. And it doesn't matter, even the educated ones, they're not able to. It doesn't much matter if they're working for some U.S. company, and U.S. company sends them dollars in an account. They can't get cash out to use the cash, because it's not like our economy where if I got money in my account, I can use my plastic or send a wire transfer and pay for whatever I want. India, it's 98% cash economy. So, I mean, it's has the potential to become a dire situation. Now, there's been a lot of commentary in the precious metals market that, nothing's really happening. I'm looking at the India's exchanges and websites, and they're saying gold's only at $1,300. Well, yeah, that's an official government source, but try actually buying it at $1,300. Our contacts in India are saying gold's well over $3,000. Matter of fact, last Friday it was about $3,000. By Sunday it was about $3,300, and now it's reportedly close to $3,600 if you want to buy actual physical gold, because everybody's desperate to get out of their cash that is now suddenly worthless by government decree. So I'd like to get your take on, I guess, first of all, India and the potential for tragedy that it could become and is quickly devolving into. And secondly, the implications on the gold market. I guess going forward in the short term, it certainly provides a massive demand for gold as Indians everywhere are panicking out of their currency. But in my mind, in the long term, if you're facing a situation like a Venezuela, that the entire economy grinds to a halt because of just ridiculous government policies, in the long run, that's probably not a good thing for Indian gold demand.
It could be a negative for Indian gold demand, and that's certainly the tone that you'll hear out of Bloomberg articles or what have you, because the thesis that the mainstream is presenting is that some 80-some-odd% of the currency in circulation are the 1,500 rupee notes that were made illegal. So, the amount of money that's available in the so-called black economy, the underground economy, to be able to purchase gold on a going forward basis is, an open question. And I think that it's going to backfire, that, we may have a period, say, 1 month from now, further on out for another 6 months or so, where the overall narrative, for lack of a better way of putting it, not so much the mechanics of the marketplace, but the narrative nonetheless being something where the Indian authorities and the policymakers there are successful in being able to at least convince some people, more so outside of India than inside, that this is going to be, something that'll curtail some gold demand. I was reading Indian Times and other local papers and how they present this whole thing with the government propaganda and mantra line about how they're going to, this is an ongoing corruption crusade of Modi. And there's a huge amount of corruption in India. There's just no denying that. I mean, India is a mess. But when they go after the people's money, the people are going to push back. I think that this is going to ultimately fail, just as the whole scheme that they did with trying to get the temples to cough up gold. I mean, I think they only were able to get maybe at most like 3 metric tons or something, very small amount in the grand scheme of things.
Yeah. Does anyone find it coincidental that Modi put in that ban around the same time that the takedown in gold and silver started happening in the United States or on the COMEX? And
yeah, if I recall, it was actually on while all the election results were coming in a week ago last Tuesday is when the story first broke.
Yes, exactly. Does anyone find that just merely coincidental?
They may be linked, they may not be. Ultimately, it doesn't matter that much. I mean,
if you recall, and I exchanged emails with John Brimlow because I know he would recall because he covers India every day. When Modi was running, he was seen as pro-business and also pro-gold, and
yeah.
And so far, everything he's done since he got in there has been to try and stop the Indians from buying gold. And
yeah,
so
he was courting the jewelry industry too, and trying to make nice with them, and he got their support as well when he got elected, and he's basically hosed them.
Right, that's my whole thing. I mean, he's basically everything policies that with respect to gold that he's put into place have been designed to try and discourage the Indians from buying gold, and obviously it's all backfired. So
there was a really weird article on Market Watch by some gentleman, I think he was Indian as well, East Indian, who was making the argument that, the whole decline in gold was not based on Trump, but that it was in fact based on the Modi's action. And the timing on that is actually not a direct sequence match, frankly. I mean, I was watching in real time, and gold started going down when India was asleep, and it was much later. I mean, it was not a direct link to the policy announcement. There may have been some additional pressure to gold. In fact, I think that's what happened. But the notion that what happened in gold in the last 2 weeks is being driven by India is, in fact, something I don't subscribe to.
No, it's not being driven by India. It's been driven in the paper market. I'm telling you, at least.
No. Of course, we're on the same page, Dave. I'm just reacting to how the narrative in the news front is, trying to paint this as if India's decision to go after the currency is what caused this correction in gold, and that's just nonsense. It helped.
Nonsense. This was a motivated takedown in the price of gold, and again, to me, they're doing it ahead of something really ugly coming, just like in 2008.
It's an ongoing preservation act, frankly. I mean.
Right. And it wouldn't have mattered if Trump got elected or Clinton got elected. They were going to take gold down. And they were going to juice the stock market like they did.
Yeah. The people getting enthusiastic about the infrastructure spends and the tax cuts, change in policy, and the fact that Congress is now going to be more unified and, less partisan division and all of that. And all of those factors being behind the Stanley Druckenmillers of the world making their prognostication known on election night and changing their portfolio and all that. There was a lot of, piling on, dogpile behavior, and so I don't think it was 100% manipulation, but it's 6 1/2 dozen or the other. I mean, the manipulation is something that is engendered in terms of the psychology and all of these big money managers are being led around by the nose too, Stanley Druckenmiller included.
Well, I think Druckenmiller knew that this was a planned thing, so I'm sure he had a peek at what was coming, given his pedigree, and given that he's basically Soros's boy. So I mean, it was nothing but pure manipulation. And you're right, the hedge funds are in there too, because what happens is they get the market moving downward, and then all of a sudden the hedge fund algos sniff that out, and boom, the next thing you know, the hedge funds are dumping contracts because they had gotten very long. They'd gotten pretty extreme on the long side of the COMEX gold open interest, and they start dumping those, and then they start going short. And I've noticed that's been kind of a pattern for the last several years, where you get an initial down leg, maybe a quick bounce, and then boom, another down leg like we've had the last couple of days. And I'm positive that's the hedge funds starting to continue dumping their longs and pile into the short side. And we won't see it today, but I'll bet you next Friday it'll reflect, unless things change drastically between now and Tuesday, which is the cutoff day for COT reporting. I bet we'll see that the hedge fund sector, the so-called managed money, I bet you they've increased their shorts and decreased their longs. And on the other side of that is the banks, which have probably cut their shorts down and increased their long position. Yeah. And that's usually the last cycle of a down leg. So
yeah. And we have seen already a significant reduction in the open interest and the commercials. The bullion banks, the bullion banks are showing signs that they were covering their shorts into this decline. So that's positive. It's setting the kindling for the next bonfire when we finally start moving back up, or in the very least, in terms of the immediate outlook, I think that we're, like I said in the article yesterday, I think even though we went down another, $12, $14 in gold, just to, in the wake of the Janet Yellen spasm, I think that we are bottoming in this week, and the next week we'll see some stability, just in part because of the craziness with the yuan, the craziness in the bond market, the dollar going bonkers to the upside, all of these dynamics having gone on for now 2 weeks running, and getting long in the tooth, and frankly getting to the point where they can be possible catalysts for markets breaking. And I think the policymakers are starting to signal that they're very concerned about that. That's what we can see when it comes to what happened in China in the last 24 hours and so forth. So time will tell.
Let's hope you're right, Eric, because if we get any further downside in gold, if 1200 is broached, certainly silver's likely looking at a 15 handle. And if that happens during a time when the U.S. Mint's not selling any Silver Eagle sales,
yeah, I
mean, that's almost an exact replica of what happened in June and July of last year. We had all the panic with, what was it, Greece at the time? I forget it now momentarily off the top of my head, but we had market panic at a time when the Mint went offline for 4 weeks. In that volume of 4 to 5 million coins that was moved elsewhere just completely sucked all other physical silver out of the market. And I mean, right now you're looking at probably 8 weeks. I mean, it's going to be, if the U.S. Mint produces coins like they typically do over the last 3 or 4 years, it's right around January 20th that the APs finally get their first batch of 2017 Silver Eagles in. So by the time they're distributed, it's really probably, you're looking at 8 to 9 weeks from now that the market would be out of the number one selling coin in the world and in U.S. markets. And for those who aren't quite understanding, what happens is when Silver Eagles aren't available, demand shifts elsewhere. First, it shifts to silver maples, and then rounds, 100-ounce bars, and basically, once those things start tightening up, it turns into a scramble for any physical metal you can get your hands on. So if you're right, Eric, and we've seen the bottom and silver recovers, gets back above 17 next week, and we have a quiet week, we might not quite see the worst of that because physical demand with premiums rising a little bit on the Silver Eagles will probably subside a little bit. But if we have anything like the type of Black Friday weeks that we've had in the last 3 or 4 years, I mean, pretty much every year the last 3 or 4 years, in the thinly traded markets on Thursday and Friday, the week of Thanksgiving, silver's been hammered between 50 and 75 cents on Friday every single year. I mean, going back 3 to 4 years, I mean, you can count on it. So
Thanksgivings have not been thankful.
certainly not. So certainly
well, wait
sets
a minute.
up.
If you're looking to buy, they've been very thankful.
Yeah, stuff the bird.
Yeah, exactly.
Well, one thing we can certainly say between now and next show will be very instructive when it comes to looking at what happens with premiums across the silver space, and that'll give us a lot of information as far as what we can tell where the market's going. Because if the market is, in fact, a lot tighter than what most people are giving credit to, then that'll show up in premiums the next time we record.
Yeah, I mean, every single time we see things that are inflection points, and when you have an inflection points, the market swings in that direction until something happens that starts to swing it back in the other direction. So I certainly can't see premiums being lower next week than they are today. Maybe I'll be proven wrong, but usually once premiums start to rise, it's almost like a negative feedback loop from retail investors to the retailers and the wholesalers themselves. I mean, it's a mad scramble for inventory. When that happens, that cycle starts to, it's a reinforcing cycle, and premiums start to rise. And then just compound that in with market of factors. And if we would see any further spot market price weakness in the face of the absence of sales from the U.S. Mint. So certainly setting up to be an interesting last 6 weeks of the year for sure in the silver market.
Yeah, and this news came out, say maybe 8:30 or so Eastern. You think?
It's about 9:30 Eastern this morning. So is when it's not like there was any public reports, but that's when the U.S. Mint started making phone calls to their APs, and basically how it happened was. I'm not sure I can name names, but one of the largest APs had a large inventory order in just for a normal weekly inventory. They sold a lot of silver over the past week, and the U.S. Mint gave them a phone call and said, oh, hey, by the way, we're not going to be able to fill that order. You're going to be able to get a fraction of that many coins that you wanted this week. And by the way, that's the last order we can take from you for the rest of the year. We won't be making any more coins available until 2017 Silver Eagles are available late January.
Well, it is interesting to note that silver is performing better in the latter portion of today's trade. I mean, once London closed and it looked like there may have even been a targeting of the London PM fix to get it on a lower price. But silver, since that point, with London closed, has been in a small uptrend, whereas gold is mostly horizontal for the remainder of Friday's trade. So who knows? Maybe people are beginning to react slightly to the news that's percolating out.
Yeah, I mean, as the news hit, silver was trading right around 1650, and it's traded up into the 1660s ever since. So certainly could be a factor. As I know, everything I've seen in the wholesale market, there's been a mad scramble for silver here this afternoon. So.
Well, another telltale, if you want to use the market as a barometer, is the Huey index, which was down. It was down over 4 points earlier. The low on the day was 179, and it's bounced back. It's starting to push 182, and then the GDXJ, it's at 34 right now, at low of 33.66, but percentage-wise, it's down less than the Huey. And Eric, as you've also noticed, it seems that ahead of a market move higher, it seems that the juniors tend to, they seem to have a better bid than the rest of the sector ahead of an overall market move. So maybe that's what's going on now.
Yeah, the miners have improved, that's for sure.
Pardon?
the miners did improve quite a bit over the course of
especially
today's trade, which is great. It's about like they've taken back on average, depending on what you're talking about, but 2/3, 3/4 of the loss has now been retraced back.
Right. Well, I've got in the fund I manage, a couple of our juniors are actually green, and in fact, one of them, Treasury Metals, is up over 5%, which also happens to be a stock that I had featured in the Mining Stock Journal at a lot lower price earlier this year. So, I'm just looking at the juniors that we hold in our fund, and most of them really aren't down that much.
All right. Well, certainly be an interesting weekend and short week next week, again with the thinly traded second half, with the U.S. closed on Thursday and then the short day on Friday. Hopefully we won't see the pattern we've seen over the last few years of smackdown in the gold and silver spot markets with thin liquidity on Thursday and Friday. But we'll wrap up the show there. Certainly, we'll keep an eyes on the market and the wholesale trends as well, and the availability, especially silver, as we move forward into the last month of 2017. So, for the doc, Eric Dubin, and our good friend Dave Kranzler of Investment Research Dynamics, thanks for tuning into this week's SD Weekly Metals and Markets.